If you thought last week's video was a snoozer because it focused on the unloved area of real estate investment trusts, then we have a real treat for you lined up this week because we're going to talk about insurance. And that's because a raft of firms from this industry are poised to report their results and declare their final dividends for 2023. Now, before you switch off in droves, do note that the life insurance sector has indeed been a weak performer, with a near 1/5 drop over the past 12 months to rank it a dismal 32nd out of the 39 sectors that make up the FTSE 350. But the non-life insurance sectors put in a much better effort, with a mid-single-digit percentage capital gain, enough to rank it 11th. You can also see how the market views the different subsectors by looking at the 5-year sector index charts here, and again, non-life is doing better than life. And this coming week should be informative thanks to results and reports from the following: Hiscox on Tuesday the 5th of March, Legal & General Lancashire on the 6th, Aviva and Beazley on the 7th, and Admiral and Just Group on Friday the 8th. Aviva, Legal & General and Just Group fall into the life category. Admiral, Hiscox, Lancashire and Beazley into non-life, although here, car insurer Admiral is a very different animal from the Lloyd's of London syndicate managers who specialise in catastrophe insurance and other niche specialities. In this respect, these different types of companies need to be studied in different ways and have different key performance metrics. For the life companies, the starting point is the solvency ratio. This measures the ability of an insurer to meet any claims that it may encounter and its financial strength in the face of any unexpected falls in asset prices or increase in liabilities. The higher the ratio, the better, and under the terms of the Solvency II regulatory regime at the first half stage of 2023, each of Aviva, Legal & General and Just Group looked pretty well capitalised. After that, attention will switch to the key business drivers, which will vary slightly from firm to firm on the life side, but they will include growth in gross written premiums, new business flows, in some cases in the area of bulk annuities or wealth management, fund flows into or out of the asset and investment management operations, and the performance of the investment portfolios, which may be affected by varying degrees by movements in interest rates, bond yields, and stock markets. These trends will drive earnings and cash flow will pay the dividends, which should be an area of focus, especially for income hunters, or indeed for those investors who are looking for an additional layer of compensation to help cover them for the risks associated with the business models. Since the great financial crisis of 2007 to 2009, Legal & General has shown an excellent track record of dividend growth, only failing to increase the distribution in the COVID-hit year of 2020, while dividend cuts in 2012, 2013 and 2019 mean that Aviva's got a much more checkered history, something that Chief Executive Amanda Blanc is determined to fix. Aviva did pay out a special dividend in 2021 following an asset disposal. For the non-life companies, two key ratios to watch are the solvency ratio but also the combined ratio. The former is again the yardstick for financial strength, as already discussed. The latter is one guide to profitability. Any combined ratio reading below 100% means the insurer is profitable, and any figure above that means it's in loss or at least seeing profitability come under distinct pressure. Beazley, for example, has just said that its combined ratio will come in lower than expected for 2023, so profits will come in higher than previously thought, and the next graphic focuses on those Lloyd's insurers. Admiral's got several business lines, including car and travel insurance, as well as financial and legal services in the UK, parts of Europe and America. Analysts will look to customer growth and for comments on pricing and claims price inflation, as well as accident frequency. An encouraging update from Sabre in February suggested pricing was helping to mitigate cost and claims inflation, but analysts will be looking for updates on potential regulatory intervention too, particularly regarding premium financing, where customers pay monthly rather than a lump sum, and also the car financing market. For the Lloyd's syndicate manager, on the other hand, investment returns will be an important factor, as they run substantial bond portfolios, so higher interest rates and yields could be helpful, and after that attention will again switch to dividends. Note that all four of Admiral, Lancashire, shown here, Hiscox and Beazley have all paid more than one special dividend in the past decade, and Lancashire has already paid a 50 cents a share special for 2023, although we must acknowledge the past is no guarantee for the future. Hope that you and your families are all well. Thank you for watching, and I look forward to seeing you again next time.